Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds in Melbourne, and this is a review of markets in February 2023. After a spectacular start for asset markets in January of this year, we've had a pullback across both bonds and equities in February because the data's actually accelerated, particularly offshore after a very, very mild winter. We've just seen this uptick, obviously the US employment situation, and then concerningly, some price pressures around the globe that are starting to re-accelerate. This has led a lot of central bankers offshore to lift their terminal rate assumptions and markets to lift their terminal rate assumptions. But things are really quite different here in Australia, where we're seeing a substantial slowdown in the data and only in the last few days an acknowledgement by the RBA that they've already done a lot and they're going to be much closer to pausing the rate hiking cycle, as we've thought for quite some time. The transmission mechanism here in Australia bites very quickly through our variable rate mortgage system, whereas it's very difficult to get that transmission from interest rate rises in the US economy because people have long dated fixed rate mortgages in particular. So it's very likely that the US powers ahead and is the last economy to slow, whereas we're already seeing a material slowing of economies like Canada, like Australia. Probably the Bank of England are the next central bank to go to a pause and assess moment. And then the ECB and obviously Japan is the huge caboose on this train of rate hiking that we're going through. For the risk outlook, obviously there is a very big cash flow crunch occurring across the domestic landscape at the moment. Invoice payment times are starting to blow out. There is a lot of pressure on working capital cycles. As invoices are not being paid incoming, it makes it a lot harder for businesses to operate, to pay costs that they are incurring, and the whole system is just under strain. This is going to continue. Discretionary spending must fall as the rubber meets the road from the rate hikes from 2022. Because of an increase in our own domestic inflation data that was released in January for the fourth quarter of 2022, the RBA have committed to a series of rate hikes in 2023. We've already had one here yesterday. We're filming this at the start of March, looking back at February, but we are now very close to a pause and assess moment. We may have one further rate hike. The problem with this is the data that we are adjusting policy on that will impact the economy towards the end of the year and into 2024 is already very ancient, being October, November and December data from last year, at a point at which the inflation picture was very different as it is today, as it will be looking down the road. So it's very likely, in our opinion, that the RBA are going to over-tighten in terms of their rate hiking program, and that will put immense stress on credit markets and on delinquency. And it probably means that they'll have to turn around and cut quite aggressively when that moment finally arrives. We are beholden, though, to the global situation, and it does sound from hearing the words of the US Federal Reserve that they are a long, long way from anything like that. And so whilst they stay at much more elevated rates, it does mean that the cavalry that would come and help out here in the domestic situation could be a lot further away than we might otherwise expect. So we continue to believe that this is a very different cycle from those that we've seen previously that have been very V-shaped. This one is more likely to be L-shaped, whereas things recalibrate, they will not quickly re-accelerate and normalize back to anything like status quo. That's very important to think through as you think across the allocations to your own portfolios, and certainly it's a moment to acknowledge that high credit quality and high asset quality is absolutely paramount. Thank you very much.